Here is something the financial industry has never said out loud to you directly. Women, on average, live 6 to 8 years longer than men. That means you will need more money in retirement, not the same amount, more. And yet every mainstream savings product, every conservative financial plan, every safe advice, column has historically steered women toward the exact strategies that make that gap harder to close. Not out of malice, out of a system that was never designed with your timeline in mind. The women who close that gap are not the ones who earned more. They are the ones who stopped saving and started investing at the right time, in the right structure, with the right understanding of what their money was actually doing while they were busy doing everything else. And there is one more number underneath this that makes the timeline even more urgent. According to a 2023 report from the National Institute on Retirement Security, women are 80% more likely than men to be impoverished in retirement. 80%. Not because they worked less or cared less, because the financial system consistently pointed them toward tools that were never designed to close that kind of gap. Today, I am breaking down exactly how that works. Not the surface version. The version most financial content skips entirely, because it requires treating you as someone who can handle real numbers and real strategy, which you can. The word saving sounds responsible. It sounds like discipline. It sounds like the right thing to do. And for a very specific purpose, your emergency fund, your short-term goals, it absolutely is. But here is what saving actually means in practice, and why the financial industry profits from you confusing it with wealth building. When you put money in a savings account, you are lending it to the bank. The bank pays you an interest rate, currently somewhere between 0.45 and 5%, depending on the account type. Then the bank takes your money and lends it to someone else at 7, 8, 10, or 21%. The spread between what they pay you and what they charge others is their profit. You are the raw material. The account that feels safe, the one that says your money is protected, is the mechanism by which the institution grows wealthier while your purchasing power slowly erodes. Inflation in the United States has averaged approximately 3.8% annually over the past century. A savings account earning 0.45% is not keeping pace with inflation. It is not even close. Every year you leave money in a standard savings account, you are losing purchasing power in real terms. The number on the screen goes up. What that number can actually buy goes down. That is not safety. That is slow erosion wearing the costume of security. There is a term for what happens to money sitting in a low-interest savings account over decades. Economists call it the inflation tax. You are not taxed directly, but inflation quietly reduces the real value of every dollar sitting still. A dollar saved in 2000 has the purchasing power of approximately 57 cents today. The money did not disappear, but its ability to buy things, groceries, healthcare, housing, shrank by nearly half over 25 years. That is what sitting still costs over a long timeline. And it is precisely why the length of a woman's financial horizon makes the decision to invest, rather than save, more consequential, not less. This is not an argument against saving. A fully funded emergency fund, 3 to 6 months of living expenses in a high-yield savings account, is non-negotiable. It is the foundation. Without it, any investment volatility can force you to sell at the wrong time and lose money you cannot afford to lose. But once that foundation exists, every dollar beyond it that stays in savings instead of investments is a dollar working below its potential. And for women with longer life expectancies, that cost compounds over time in a way that cannot be reversed by working harder in your 60s. So what does investing actually mean, and why has it historically felt like it was not built for you? Investing means putting your money into assets that generate returns through ownership rather than lending. When you buy a share of an index fund, you become a partial owner of the companies inside it. When those companies grow, when their profits increase, when their value rises, your ownership stake rises with it. You are not lending. You are owning. And ownership, over long time horizons, has produced returns that no savings account can match. The S&P 500, an index of the 500 largest publicly traded companies in the United States, has returned an average of approximately 7% annually over the past 30 years, Not every year. 2008, it fell 38%. 2022, it fell 19%. But over every rolling 20-year period in recorded history, it has produced a positive return. Every single one. No exceptions. The financial industry has historically framed investing as complex, risky, and better left to experts, most of whom were men, speaking to men, about strategies designed around male financial timelines. A man retiring at 65 with a 15-year life expectancy needs a different investment strategy than a woman retiring at 65 with a 22-year life expectancy. That distinction matters enormously in portfolio construction. Most mainstream advice ignores it entirely. Here is where it gets really important, and where most financial content stops short of telling you what you actually need to know. The single most powerful force in investing is not picking the right stock. It is not timing the market. It is not finding the best fund manager. It is time. Specifically, it is the amount of time your money has to compound before you need it. Compound returns work like this. If you invest $10,000 today at a 7% average annual return, which is the S&P 500's historical average after adjusting for inflation, in 10 years you have approximately $19,700. In 20 years, $38,700. In 30 years, $76,100. You put in $10,000. You end up with $76,100. The $66,100 difference was produced entirely by time and compounding, not by additional contributions, not by clever stock picking, not by timing the market. A Roth IRA is one of the most powerful investment vehicles available to ordinary Americans, and one of the most underutilized, particularly by women who were historically told it was too complex or not relevant to their situation. Here is how it works. You contribute after tax dollars, money you have already paid income tax on, up to $7,000 per year as of 2024. That money grows inside the account completely tax-free. When you withdraw it in retirement, you pay zero tax on it, including all the growth. All of it. A woman who contributes $7,000 per year to a Roth IRA from age 30 to 65, earning a 7% average annual return, will have approximately $1.1 million at retirement. She will pay zero tax on any of it when she withdraws it. The IRAs cannot touch money that grew inside a Roth IRA. That is not a loophole. It is the intended design. Most people who qualify never open one. If your employer offers a 401k with a matching contribution, that is the first place your investment dollars should go, up to the match. The employer match is a 50 to 100% instant return on that portion of your money. No investment in the world offers a guaranteed return that high. After the match is captured, open a Roth IRA and contribute up to the annual limit. After that, if you have additional dollars to invest, a standard brokerage account in low-cost index funds is the next step. Now let us talk about the thing most investment content never addresses honestly, the psychology of staying invested when markets fall. Because this is where most investors lose, not by choosing the wrong fund, by choosing the right fund and then panicking out of it at the wrong moment. In 2008, the S&P 500 fell 38%. Millions of Americans sold their investments at the bottom, locking in losses permanently. Because the news was catastrophic, the fear was real, and every instinct said get out. The market recovered to its previous level within 4 years. By 2013, it had exceeded its 2007 peak. The investors who stayed invested through the crash recovered everything and made significant gains. The investors who sold recovered nothing until they reinvested, often at higher prices, after missing the recovery entirely. Market downturns are not anomalies. They are part of the process. Since 1950, the S&P 500 has experienced a decline of 10% or more approximately every 16 months on average. A decline of 20% or more, a bear market, happens roughly every 3 to 4 years. These are not emergencies. They are the price of admission for the returns that compound over decades. The investor who understands this in advance is not rattled by a 15% drop. The investor who did not understand this sells at the bottom and misses the recovery. The tool that makes staying invested psychologically manageable is called dollar-cost averaging. Instead of investing a lump sum and watching it fall immediately, which is psychologically devastating and leads to panic selling, you invest a fixed amount on a fixed schedule. Every month, regardless of what the market is doing, the same dollar amount goes in. When the market is high, your fixed amount buys fewer shares. When the market is low, your fixed amount buys more shares. Over time, this averages your cost per share in a way that naturally benefits you during downturns. The months the market drops are the months your regular contribution buys the most, which means recoveries become even more profitable than they would have been otherwise. Setting up automatic monthly contributions to your investment account eliminates the decision entirely. You do not have to decide whether now is a good time to invest. You do not have to watch the market. The money moves on the same day every month, in both good markets and bad ones, building your position continuously without requiring willpower or vigilance from you. This is the mechanism that makes ordinary people wealthy over time. Not brilliant stock picks. Not market timing. Not expertise. Consistent automatic contributions to low-cost index funds inside tax-advantaged accounts started as early as possible and left alone through the volatility that is simply part of how markets work. Research from Fidelity Investments, one of the largest retirement account providers in the country, found that their best-performing accounts over a 10-year period belonged to investors who had either forgotten they had an account or had died. Not the most active traders, not the most informed investors, the ones who did nothing, the ones who set it up, automated the contributions, and let the market do its work undisturbed. That finding is both humbling and liberating, because it means the highest skill move in long-term investing is learning to do less, not more. There is one more layer worth understanding, and it is the one that most financial content written for general audiences never reaches. Asset allocation. This is the decision about how to divide your investment portfolio between different types of assets, primarily stocks and bonds, and it is the decision that has the greatest impact on your long-term returns and your ability to stay invested through volatility. Stocks produce higher long-term returns but with more volatility. Bonds produce lower returns but with more stability. A portfolio that is 100% stocks will grow faster over 30 years, but it will also fall harder in downturns, which makes it psychologically difficult to hold. A portfolio with some bonds will grow more slowly but will fall less dramatically, which makes it easier to stay invested. The traditional rule of thumb was to subtract your age from 110 to get your stock allocation. A 35-year-old would hold 75% stocks and 25% bonds. But given that women live longer and need their money to last further into retirement, many financial planners now suggest a more aggressive stock allocation for women, particularly in their 30s and 40s, to ensure the portfolio grows enough to sustain a longer retirement. A 35-year-old woman with a 30-year investment horizon can absorb significant volatility along the way. The time is there to recover. Being too conservative too early is its own form of risk. The risk of running out of money because the portfolio did not grow enough. A simple starting allocation for a woman in her 30s, 80 to 90% in a broad stock market index fund, 10 to 20% in a bond index fund. As you approach retirement, you shift gradually toward more bonds, not all at once, but year by year, to reduce the portfolio's sensitivity to market swings in the years when you are about to start withdrawing. This does not require a financial advisor to execute. Vanguard, Fidelity, and Schwab all offer target date retirement funds that do this rebalancing automatically. You choose the fund with the year closest to your expected retirement, and the fund manages the allocation shift for you over time. The fees are low. The strategy is sound. The execution requires one decision. So here is where everything lands. Saving is not building wealth. It is preserving short-term liquidity. Every dollar you need within the next 1 to 3 years belongs in a high-yield savings account. Every dollar beyond that has a longer time horizon, and a longer time horizon means investing, not saving, is the tool that matches the job. The system that has historically kept women underinvested is not going to correct itself. The gap in financial advice, the gap in tailored investment content, the gap between what women are told and what actually serves their financial reality, those gaps have existed for decades. Closing them requires understanding what the strategy actually is, not what the industry finds convenient to explain. You now know the difference between saving and investing. You know how compound returns work, and what a 5-year delay actually costs. You know the case for index funds over active management, the structure of a Roth IRA, the mechanics of dollar cost averaging, and the basic logic of asset allocation across a longer investment timeline. Most people spend years acquiring financial knowledge they never act on. They read the articles, watch the videos, understand the concepts, and then continue doing what they have always done. Because the gap between knowing and starting feels wider than it actually is. The account opening takes 15 minutes. The contribution can be $50. The fund selection can be a single target date fund. None of this requires perfection. None of it requires certainty. It requires only the decision that today is the day you stop being someone who understands investing and start being someone who is invested. The one action worth taking today, not this week, not after more research, is opening the account. A Roth IRA at Fidelity or Vanguard takes approximately 15 minutes. Contribute whatever you can, even if it is $50. Set up a recurring monthly contribution. Choose a target date fund or a total market index fund. Then leave it alone and let compounding do what it does best, which is work quietly and relentlessly on your behalf for as long as you give it time. The question worth sitting with is this: if the version of you at 65 could look back at this exact moment, knowing what she knows about what compounding produces over 30 years, what would she want you to do today? And what is actually stopping you from doing it?